Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Thank you for joining us. Today we'll be discussing investment myths. My name's Chris Ruedi, and I'm a financial advisor in Savant's Bloomington, Illinois office. I'm happy to be here to review some of the things that you may have heard or possibly read that we feel just aren't accurate when it comes to investing. Joining me today is fellow financial advisor and colleague Jeff Lewis. Jeff, thanks for being here.
Yeah, thanks, Chris. Happy to be here. Looking forward to today's presentation. I think we've got some good information to cover and looking forward to it.
Same here. You know, Jeff, when we were looking at the things that could possibly be covered in today's webinar under the topic of myth in investing, you know, there's so many things out there that I think come with some needed clarification or really just have elements that aren't based in any fact or truth that, you know, we as investment advisors see or hear about quite often. So what we've identified today, and they're always phrased in a little different way, but essentially around the main ideas and conversations that I think we have on a regular basis that we hear from investors who maybe have read some of these things that aren't, you know, always there for anything other than just be to refer to as a myth. So I'm going to take the first three topics you see listed here, and then we're going to turn it over to Jeff to touch on the items that he's highlighting today. And then of course we'll get to that Q&A. So, you know, my first topic, first myth, if you will, you need to be an expert to invest. Something that we hear, you know, a lot of the time as well. I don't really understand it. I'm not an expert in that, and now I'm hesitant to do it. My counter to that a lot of times is, well, most of us aren't doctors or lawyers, but we still follow their recommendations, believing that they know, you know, what is in our best interest. So why not, in many senses, take the same approach with our own investments? Now, I'm not suggesting that having a base understanding isn't important. I think it's entirely critical for investors to be informed about what their portfolios look like, how it fits, hopefully as part of their larger financial plan. But would also caution that if you don't understand absolutely everything, you could be missing out on some things that really do bring value. There's a number of techniques and solution that investment professionals might propose, and we've just got a few of them listed here on the slide that, you know, really could add, you know, value for the appropriate investor. Again, not to say that any one of these things that are highlighted here, either on the slide or that we might reference, is appropriate for every investor to use. There may be some combination of solutions, but just to reiterate, you may not have to understand every technical aspect of a solution that's being presented to you to consider as part of your investment portfolio, but understand there are things out there that could add some value. The last point, talking about a team of trusted advisors, I think is really what brings this method home and hopefully debunks that myth that you need to be an expert. You don't have to understand absolutely everything about a particular strategy, but hopefully you do have someone you can look to in a level of trust, whether that's an investment manager, a tax advisor, someone who's helping with estate planning, and know that they have your best interest at heart. And, you know, what I suggest to folks in conversations that I have is, you know, a qualified advisor should be able to explain, you know, why a certain approach is beneficial, why it provides benefit to you as the investor in a high level way that you can come away with an understanding without getting tied up in so many of the details. So, you know, my goal in conversations that I have when discussing some of these more advanced techniques is hopefully somebody could leave our meeting, go meet a friend for lunch, go meet someone for coffee the following morning, and if asked and talking about, could explain, hey, I'm not really sure all the ins and outs of what I'm doing, but I know why. It's to address this specific challenge or specific unique part of my portfolio. So just something to keep in mind and consider. You know, one example to highlight of that and something that's becoming more prevalent in our investment world is something referred to as custom indexing or maybe direct indexing, and not a term that many people outside of the investment profession might be familiar with. But when we can, provide an understanding of what custom indexing is, and you'll see it here on the slide, or, why we think it's beneficial, which is, also written up there. What we would describe this to someone we felt like it was appropriate for is nothing wrong with having, just a traditional mixture of mutual funds in your portfolio. People have done that in a tried and true way for many years. But as time goes on, technology evolves. And so with the ability to leverage additional technology, we can actually use something like this custom indexing solution to, hopefully take advantage. And in this case, this is a tax advantage that we're trying to gain by doing more frequent capital gains, loss harvesting, taking advantage of individual stocks and their movements on a day-to-day basis to try to improve that after-tax return that an investor might get. Now, again, we could dive into exactly how all of this works, but the takeaway is this is a way that certain individuals can use a more advanced solution to try to capture a capital gains advantage. Other examples of these would be, and Jeff, not to steal your thunder, I know you're going to be touching on this later. There are things outside of what many of us would think of as traditional investments, whether they're stocks or bonds, individual stocks, or using funds of some variety. We refer to these types of investments as alternatives. Again, not something that maybe the everyday investor is familiar with, but within each of these little bubbles is a specific way to either become maybe more diversified or to capture a certain aspect of investment that's more unique and not maybe correlated with stocks or bonds, making you more diversified. So just to reiterate, we don't feel like you have to be an expert in absolutely everything that you're invested in, but look and partner with someone who is, and that can explain to you what those benefits are. Second topic I'll touch on today, and hear this quite often. You're too old or maybe too young to start investing. For me, that's really, you can start investing at any age. And I think that's, what would the myth to be busted? I think you can start investing at any age. It can be appropriate. For younger, earlier investors, maybe just starting off in your career, maybe first participating in maybe a workplace retirement plan, even small amounts, time is really on your side as an early investor or a younger investor. And even small investments, recurring, compounded with the element of time, can grow to large amounts. So would encourage someone not to be dissuaded just by their age to take the time to start investing. And a great way to do that, many times is through your workplace retirement plans. At the same time, older investors, folks who maybe have been working in their careers for some time, who maybe have had other draws for their money, whether that's paying off a mortgage or helping, pay for college. If you just felt like you haven't had the disposable income to invest for the longer term, or maybe for retirement, for example, there's several provisions for investors age 50 and above to add larger, even additional amounts than what any of us as participants in retirement plans or retiree savers can do on an annual basis. And really all that gets to is longevity, not something to be ignored. None of us know how much time we have here on Earth, but as a population, we know that statistically we are living longer. So even if you felt like, hey, I'm a little bit behind in maybe starting or planning for a retirement, setting money aside, it's never too late to get started, because one, as I mentioned, with those additional provisions for older investors to put more money aside into retirement plans, chances are we're going to be living longer, and we need to plan for that. So, starting investing at any age, can be a very good thing. And just that last bullet point I'll comment on. We are starting to see a shift, and have over the last several years, of the idea of a traditional typical pension fund that may have been much more prevalent 30 and 40 years ago, is less and less an option for many investors if they choose to have a more traditional retirement where they step back from maybe only having things like Social Security and their own investment portfolio to fund those expenses in retirement. So again, just plays to never too late to get started to be an investor. So what I've got up here is just for this calendar year, and know that the IRS adjusts these figures each year for inflation, but you can see the various types of, and the most common retirement plans, up to 23,500 for a 401k, 7,000 for an IRA. But really what I wanted to hone in on is, like for this year, not only for employees who are 50 and older can add an additional 7,500 into something like a 401k plan, but those that are 60 to 63, or in the case of a simple IRA, even 64 and older, you can add even additional amounts beyond the first tier of catch-up contributions. So the push is there to help investors have enough time, have the ability to put tax advantage money into things like workplace retirement accounts, and would just point that out as a reminder to everyone: you're never too old or too young to invest. Graphically, kind of speaking to the same thing here, you can kind of see that time value of money, the growth of a dollar, going all the way back to 1926 through mostly the end of last year, and really I think speaks to, yes, you can invest it or keep cash. Savings are always important, but having it invested in some capacity is really what's going to provide that, I think, exponential growth that many of us are looking for to fund retirement when we're no longer working. The last topic I'll cover this afternoon is investing is just a game of luck, or maybe said another way, it's like gambling. You could lose it all in the markets. I mean, we've heard it presented in many different ways, but it gets down to, hey, this might be too risky. This might be too much left to chance and not enough to skill or discipline. So, what I would say to that myth, if you will, there are certainly aspects of investing that could be akin or likened to gambling. Whether that's short-term day or even shorter trading, speculative. You're trying to capture a very short-term profit. Markets are tend to be very volatile in the short run. If you're borrowing to invest, sometimes referred to as leveraged trading. Maybe folks are familiar with the term options. They're just more complex ways to, make short-term investments, hoping a certain thing happens, and if it does, you win, and if it doesn't, you could be out that investment principle. Many years ago now, 2-3 years ago, the emergence of the meme stocks is what they were referred to in the news. Things that were very speculative in nature that gained mass popularity. We saw huge swings, and for every story about the person who made a lot of money, you heard just as many, or probably didn't hear about the ones that didn't fare so well. So there are certainly aspects of the investment world, where you could have risk of substantial loss. Where I think we're trying to target the folks who are in attendance on this webinar today is something, what we would refer to more as being actually a long-term investor, instead of someone trying to capture those short-term, quick profits, quick turnaround types of investments. And what embodies a long-term investor, and hopefully someone who would be at lower risk of large-scale losses, or God forbid, a complete loss of their portfolio value. Well, one, we talked about not having to be an expert, but you do need to be educated. You need to know, to some extent, what you're buying into, why you're buying into it, and how that can ultimately, hopefully, benefit your individual outcome. You need to be disciplined. Many times markets in the short run can be volatile. It can be very emotional to see swings in your portfolio value, but, hopefully either through partnering with an advisor or if you're a do-it-yourself investor, having a degree of discipline to know, hey, I'm invested. I know things aren't going to go up every single day or every single week or every single year, but more often than not, I'm buying into something that I think has that growth potential to provide that value in a positive way over longer periods. Being diversified, not having all of your eggs in one basket certainly limits that potential for large scale or total losses. So, making sure that your portfolio is not concentrated in, maybe one stock or even in one industry, but hopefully you have a mixture of different types of investments that, while some do well, others may pull back in some instance, but hopefully by being more blended, more diversified, you'll have a smoother result and ultimately be able to stay the course, maybe help you be more disciplined. Planning and research historical data. We've probably, many of us, heard the term, past performance isn't indicative of future results. But I would quickly say we can't ignore what history has provided, and it's the only guide that we have. We don't know what the future holds, but when we're doing planning, when we're talking about how we might need to be invested in service of our own personal goals, you know, using research, looking at that historical data over, what investments have provided, I think can't be ignored. So, we would steer people more to the bottom part of this slide. Think of yourself, if you're going to be an investor, as something more long-term, especially as a way to, hopefully take out that gambling aspect or the feel that, hey, I'm just getting bounced around here. I'm at risk of really, potential large setbacks or complete losses. So, I think adopting some of these principles should help maybe someone not feel quite that way. And again, just to kind of maybe illustrate that point I was trying to make, what you see up here on the screen is, what we would think of as historically a very traditional retirement portfolio, something maybe 60% in diversified equities. So, several different types of stocks, 40% into things like fixed income bonds, again, in kind of a diversified nature. And really looking at over the last 51 years, over longer periods of time, and in this chart specifically talking about, 10-year periods. Well, for every 10-year period there, more often than not, we see the outcome from the start year to the end of the 10th year returning in a positive way. In fact, you can kind of see down there in this example, in this hypothetical portfolio, that worst 10-year period, maybe you were just under flat. And of the 505 different 10-year periods that we could make over the last 50 years, really only 4 instances were they even negative. So again, that speaks to not having a short-term mentality, having a little bit larger long-term mentality will hopefully then continue to bear this out. And you can look at 20-year periods, 30-year periods, you can go shorter. And I think it all tells the story. More often than not, if you can stay disciplined, stay involved in what you're doing, your chances of a good positive outcome are greatly increased. So Jeff, those are my 3 topics, myths that, I certainly wanted to address. Ready to hear about the ones that you've come up with. And so with that, turn it over to you.
Yeah, thanks, Chris. I like how you kind of, ended that last one in terms of, because we all, from time to time get that, question of it feels like gambling, or maybe it's more of a concern or a feeling is like, man, sometimes I just feel like I'm gambling in the market. I have no idea what's going to happen next. And I think you did a good job of just kind of portraying there, on any given day or any given week or any given month, really, nobody really knows if the market is going to be positive or negative during that time period. You look to some of the best investors to, ever do it, and most of them will say, yeah, it's really hard to, try to time the market or outsmart the market on a day-to-day basis, because you have millions of people placing trades throughout the day. So if you're thinking that you know something that somebody else doesn't already know, the other tens of millions of people that are also placing trades, it's pretty unlikely. But kind of segueing into kind of these next three myths that I will be covering. One we hear all the time, either from individuals, you read about it or you hear about it on TV. Market timing works. So you think about buying low, selling high, buying high and selling higher. I really like kind of this chart that we have up on the screen. It's sometimes referred to as a quilt chart or a Callan chart, depending on who you talk to. But the whole idea behind it is I'd like you guys to challenge yourself and see if you can find a pattern. Going back to 2007, do you see any sort of pattern with the colors on that chart? And I'll give you a second to kind of take a look at it. So hopefully, as you look through this, it's like, okay, yeah, I see a lot of colors, but I don't really see any consistency from year to year. Sure, yeah, maybe there's a couple years in there where you see a color towards the bottom or towards the top. But when you take that data set and you spread it across, 15, 20 years of time, basically there's no trend amongst the colors that you'll see. So on the far left-hand side, those are all the individual asset classes available to an investor that they could potentially invest in. So you think about US large stocks, that's your S&P 500, and then there's all the additional asset classes that you as an investor can participate in. And the one that the area of time that I always focus on, or at least point to as an example, when you're looking at those first 3 years on the chart. So we all know what happened in 2007, 2008, and 2009. The economy went through kind of a global financial crisis, the worst recession we had seen going back over 100, close to 100 years, back to the Great Depression in the 1920s. And I just like to focus on this because I think the story tells a lot more to it than just this chart as a whole. So when you look in 2007, the best performing asset class at that time in 2007 was emerging markets. So countries like Russia, Brazil, China, India, Mexico, developing countries that have a lot of population growth. They have a lot of population density. There's a lot more opportunity for growth there as opposed to maybe other parts of the world. Well, in 2007, they were up nearly 40%. 2008 comes along, and you can see on that next year, that investment asset class lost over half of its value in a 12-month period. So think about the 24-hour news cycle that we live in today. I mean, I almost hear it in my head today. In 2007, people were saying, oh, yeah, buy emerging markets, China, Russia, India, Brazil, they're growing like crazy. The opportunity is there in these developing economies. 2008 happens and it flips, right? That switch flips and they're saying, oh, you know what? We're not as confident about, this area of the world. Here's reasons X, Y, Z, Y. You should probably sell out of, that part of the world. But what the data tells you when you have the hindsight and the benefit of looking back is in 2009, just the very next year, those emerging market countries recovered to be the best performing asset class by a wide margin in 2009. And so when I think about this chart and the story that it tells, is it goes back to there is always going to be good years and bad years when it comes to investing. There are always going to be things as a diversified investor that you want to own more of and things that you want less of if they're underperforming. The hard part is none of us can really predict on a year-to-year basis which asset classes those should be. And it becomes very difficult when you're trying to guess or time the market, getting in and out on a day-to-day basis. It becomes really difficult to put together a portfolio when your strategy is more built on day-to-day trading or trying to beat what the market is doing. Just a very difficult task to really accomplish as an investor. So as illustratively, right, as we think about this buying and holding versus market timing, I think this chart does a good job of just kind of showing the power of staying invested despite going through difficult time periods like 2008. In this scenario, this basically assumes anytime there's a 5% drop in the market timer sells out, and then they wait for the market to recover by 3 percentage points to get back in. So again, trying to get in and out, time the market, versus somebody who just bought the index and held it all the way through, going back to 1990, all the way up until 2024. And you can see, over that time period, a growth of $10,000 has a big difference just based on staying invested versus trying to time the market. And again, it just goes back to preaching the importance of there's going to be time periods when you're investing and it doesn't feel good. It doesn't feel good for you as an individual. Sometimes as an advisor, you're also not feeling, good or confident about markets in short terms. But it's always comes back to that long-term focus of, are you doing the things in your control to make sure that your plan is in a strong spot? Because investments are just something we inherently cannot control. Nobody can control them. So making sure that you're just in a position where, okay, we know you're going to go through good and bad markets. How are you positioned both in the short term and the long term to weather those difficult time periods? So moving on to kind of the next myth of things that we hear about, investing is only about stocks. And this is something that I think has changed over the years, especially in our space. When we're, talking about wealth management, financial planning, I think of a portfolio as having kind of three legs to the stool. So you've got stocks, bonds, alternatives, and then obviously there's always that portion of cash that you're keeping in your checking or your savings account, or maybe a high yield cash account that you have. But focusing more on kind of stocks, bonds, and alternatives. The whole idea of having a well-established, well-oiled engine portfolio is that you have things in it that are going to perform differently during different market cycles. So obviously your stocks is what are going to provide you your long-term growth. You want to make sure that those are liquid. They're providing you a certain amount of diversification where you're protected against large swings in the market. But obviously, as an investor, part of investing is getting those dividends paid to you, which could be really nice as well. Bonds, on the other hand, when I think about bonds, bonds are not really there to provide that, really high expected rate of return long term. They're really there to be the stable part of the portfolio that provides you stable cash flow during retirement. And, one of the questions that, we've always gotten is, it's been a difficult time period in the last 10 to 15 years to be a bond investor. You think about how low interest rates were going all the way up into 2022. It wasn't just until recently where bonds started paying more attractive yields of 4.5%, 5%, 6%. But having something there when stocks are going through a very volatile time period where you can rely upon some of that for cash flow, that's really where bonds come into play and can play a really important role within the portfolio. And then lastly, and we'll talk a little bit more about this from the alternative side, is, this is kind of that third leg of the stool, right? So this is that third leg, that diversifying aspect that Chris was talking about earlier. And making sure like, okay, yes, I have exposure to traditional stock bond investments. That's kind of the traditional way of doing things. That's what you're taught in school growing up. That's what people are familiar with. But really, alternative investments have become more prevalent in the last 10 years for your average mainstream investor. And so when I think about, real assets or event-driven strategies or reinsurance, whatever it may be, having exposure to different areas of the market that, again, are not correlated to stocks and bonds. Because remember, the whole idea of building a diversified portfolio is to have things that are acting differently during different market cycles. I think a lot of people would be surprised to know that just last year in 2024, right behind the S&P 500, one of the better performing asset classes in 2024 was reinsurance. A lot of people don't know that. A lot of people don't understand that. And there's a lot of reasons why it goes into that. But having different things in your portfolio that act differently on a year-to-year basis, but certainly over a 5 or a 10 or a 15-year rolling time period, incredibly important as you start thinking about what retirement may look like, or if you're already in that retirement phase. And then, so again, this is the last one, and again, a popular one that we hear a lot. Stocks are too risky. And when you think about traditional investments that are available to mainstream investors, yeah, stocks are probably the most, risky investment out there on average, kind of across the board, because they come with the most volatility. With volatility comes the potential for higher expected returns as well. Obviously, there's no guarantee at the end of the day, but you have to take risk in order to earn return over time. And I think this chart does a really good job of just highlighting the importance of staying invested, even if you're going through a difficult time period. Because I think sometimes what is misunderstood is when markets are really, really volatile, meaning they're going up a lot or they're going down a lot, because it goes both ways. Those are generally the days where markets are moving the most. So if you think about it, if you miss one of those days or 5 of those days where the market has a big upswing or a big downswing, that can really impact the long-term rate of return that you earn over a longer period of time. And so when you kind of attach a dollar amount to it, I think, in this case, it's $10,000. You can see if you miss the best one day, 5 days, 15 days, whatever it may be, the difference it has in your annualized compound rate of return over a 20 to 25-year time period, it's drastic. It's real. It's nominal. It feels real. And so, preaching the ever so important pillar of patience and discipline, I think is incredibly important for anybody who is either feeling just emotionally unstable when it comes to, stocks in general. Because, when we think about it from a long-term perspective, most people who are retiring at 60, 65 on average generally are going to have some sort of allocation towards stocks over the long term, because they want those stocks to be there to keep pace with, inflation, keep up with the purchasing power of what cost of goods cost these days. And your stocks are going to be your best hedge against that inflation. So just keep that in mind as you're thinking about those things. Like I said, it's very difficult, but at the end of the day, if you can stay disciplined, if you can stay patient, generally speaking, you're going to be better off over a longer period of time. So if you have questions, as you think through some of this, if there's something that popped in your head as we were going through the presentation today, feel free to click the link in the chat to schedule a 15-minute phone call with us. We obviously love to talk to you, answer any questions you may have, to try to point you in the direction that you may need. But feel free to use that link in there as well to schedule a call with us, and we'll be happy to talk with you then. I know we're going to get to some Q&A as well, but I know we've got some nice disclosure slides, as always, from our nice compliance team. So we'll put those up on screen quickly. And then I'm actually going to turn it back over to you, Chris, because I know you've been monitoring that Q&A chat as we've been going through this. So I'll kick it back to you for the first question, and then obviously I'll chime in along the way as well.
Thanks, Jeff. Yes, we'll now get to the point where I think we all want, besides the disclosures, the questions that have been coming in, and there have been several. So we really appreciate getting those questions, and don't know that we'll have time to get to too many with the allotted time we have remaining today. But one of the questions that I see here, and I'm glad somebody brought it up because I see it a lot, is there are so many sayings out there, idioms that people bring up, and I think don't know whether there's a lot of truth to what this investment saying is or not. And so one of them is the question is the idea of "so goes January, so goes the year" indicative or mean anything for markets or in terms of results? No, my feeling would be no. That's an example of one that could have been a myth in our presentation today. There's nothing special about the start of a year, especially statistically when we look back on it. more often than not, we see so many news stories that say, "Oh, the S&P or the market or whatever index you might be referring to, had its best 7-day start, or maybe on the downside, maybe the worst 5-day period to start a year, for example." Well, if that 5-day or 7-day period up or down happened in the middle of April, it probably doesn't even get talked about all that much. So, I think just dispelling the myth that there's nothing special about the beginning of a year that is indicative of what result we might see. I can think of several recent examples. 2018 was a year where markets were started off very strong, were high throughout the year. And towards the end of the fourth quarter, the Federal Reserve started raising interest rates or even talking about raising interest rates. And we gave back most of the gains that we had for the year and maybe almost finished negatively a little bit. Uh, 2023 was a fairly modest year most of the year, and then at the very end we saw incredible rally and performance. So nothing early on in the year guarantees what will happen throughout the middle and latter part of the year. And so, we just certainly encourage folks not to try to use a phrase or a theory just because it may have worked out that way a time or two in the past. Is certainly no guarantee that that's something that you should bank on going forward. So great question. I appreciate that. That's always one that we like to speak to. So I'm glad somebody had a similar thought. Jeff, you want to take the next one?
Yeah, and I'll just add to that because I've heard the sell in May, go away. I mean, there's all sort of those out there. The sell in May, go away thing is interesting because I don't have this data in front of me, so don't quote me on this, but I'm sure if you looked at if you looked at the next 12 months of investment returns on a rolling average basis after the month of May, going back over 50 years, I would guess that most of the returns in those scenarios are going to be quite positive. But for some reason, there's this sell in May, go away type of deal. It's like all of these sayings that I think make great headlines when you're, clickbait online. You got to be careful with some of those. But no, those are all good. One of the prevailing questions that was in the chat was, as I approach retirement, should I be more conservative? We get this question quite a bit, and I would say, the answer depends, and it might surprise you that in most cases, it actually may be no. You may not need to be more conservative, nor should you be more conservative. I think what a lot of this goes back to is having a strong financial plan that's kind of rooted in statistical analysis to help answer this question. Longevity, to be, forefront, longevity has changed the answer to this question dramatically in the last 20 years. You think about advances in technology, medicine, healthcare, people are living longer than they ever have been. And I don't anticipate that trend to revert back the other way. I think the trend of longevity is here to stay just based on the advancements that we're making overall as a society within terms of how we treat individuals. So you think about, you work until you're 60, maybe you got your first full-time job and you really got on your feet when you were 22. So let's round and say you worked for 40 years. Well, you could easily, going forward, live for another 25 or 30 years. And I could argue if the trend that we're on from an advancement in how we treat people medically continues this way, that people are going to live well into their 90s pretty regularly going forward. You could have 30 or 35 years where you need these monies to last just for your own retirement. And so maintaining, not to say, an incredibly aggressive allocation, but having exposure to stocks, to bonds, to alternatives, having a nice mixture there, making sure that the portfolio that you have is designed to keep pace with the rate of inflation. That's all going to be really important going forward, more important than it ever has been, as longevity continues to increasingly last longer and longer. So that's my 2 cents, Chris. I don't know if you've got different feelings on that or not.
No, I think it's great, and I don't know that we can spend enough time on any webinar or any meeting to really hit that point. And I think you said it well. I think, Jeff, I'll take the last one here. And in light of time, we will get to all of your questions. And again, please keep continuing to send them. But the last one we'll maybe take live here today. Question about investing in annuities, and someone who has purchased one, and rightfully so, mentioning that, hey, I was fearful of larger losses, or it was somewhat of an emotional decision. What I will take from that question about annuities is, I certainly think an annuity is a type of investment that could be appropriate for some people. Now, my personal feeling is that category of appropriate investor is probably not one that's all that big. If someone has other resources, if they have other means of deriving, maybe retirement income if they're looking for that, especially if you've done any degree of planning, either throughout your working career or, maybe possibly before retirement. So often, and this is maybe what I'll say is kind of the myth with, maybe not all annuities, but so many of them are pitched as you can only go up, it can never go down, as a way to kind of put some of your fears at ease. And there may be an element of truth to that, but I think so often the give up, the things that aren't talked about as much as maybe Jeff or I would like to see, that go along with that type of comment, don't get highlighted. And so, there are certain annuities out there where you do only get credit in a positive direction. It won't go down, but it also means you tie up your money for maybe sometimes 7, 10, I've seen as large as 15 years. And if you decide that you want to do something different, or you want to invest in a different way, if your circumstances change, you could be looking at some pretty steep penalties to get your money back, if at all, if you can. Sometimes there's bonus funds that are added to that value, but yet you can't get your hands on it if you want to change and go do something else. The other thing I'll just mention with regard to those types of annuities is there's somewhat of a cap on that upside. So the thing that you give up for never going backwards is you could be leaving a lot of return on the table in the years where we've had pretty high market returns. 3 out of the last 4 years I would put into that category. So, making sure, again, maybe going back to one of the comments that I had, you don't have to be an expert, but be informed. Ask the questions. Ask, if you don't know which questions to ask, there's all kinds of resources online. You can come prepared and really get the ins and outs, because, I think maybe the myth sometimes is it sounds too good to be true. It probably is. And, I think, the question was about annuities. And again, not to say that it doesn't have a place for certain people, but that is one particular area of the investment world where I do think you can't ask enough questions or do enough research to know, hey, for what I think I'm getting, what am I giving up? And more often than not, I think with good planning, you can position yourself, your portfolio, in a way that you can kind of take some of the emotion out of it. You can kind of instill against larger swings in the equity side if you've built up, as Jeff was saying, either an appropriate allocation to bonds or some of maybe those alternative investments, even having a surplus amount of cash on hand to get through short and intermediate period downturns. So, I think that's what my comments and thoughts on annuities would be. Again, appreciate the question. Jeff, if you have any comments, I'd certainly like to hear it. Otherwise, I think we can kind of wrap it up for this afternoon.
Yeah, no, I think you hit the point on the head, and I love the quote about if it sounds too good to be true, it probably is, because that's normally the case.
Well, hey, can't thank you enough for presenting with me. I think it's a topic, hopefully, for viewers, that you found it helpful in some capacity, and look forward to responding to your individual questions following today's webinar. So appreciate everyone's time. Hope you have a great rest of your week. Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.